Reaching the age of 60 often marks a significant milestone. For many, it means leaving behind the daily grind of work and entering a new chapter of life, retirement. This transition brings with it both excitement and a unique set of financial challenges. One of the most pressing questions for retirees is how to invest safely to preserve wealth, generate income, and ensure financial security throughout the golden years. Navigating the investment landscape after 60 requires a thoughtful approach, balancing the desire for growth with the need for safety and stability. The first principle to understand is that investment goals typically shift as we age. In earlier decades, the focus might have been on aggressive growth, taking advantage of long-time horizons to weather market fluctuations. But after 60, priorities tend to change. Preserving capital becomes paramount, as does generating a steady income stream to cover living expenses, healthcare, and perhaps even a few well-deserved luxuries. Risk tolerance generally decreases, and the ability to recover from significant market downturns becomes more limited. With this in mind, let's explore some of the best investment options for retirees seeking safety and reliable returns. One of the foundational elements of a safe retirement portfolio is diversification. Spreading investments across different asset classes, such as stocks, bonds, real estate, and cash, helps reduce risk. This way, if one area underperforms, others can help cushion the impact. For retirees, the mix should be tailored to individual circumstances, but the emphasis often shifts toward more conservative holdings. Fixed income investments, like bonds, are a cornerstone for many retirees. Government bonds, such as U.S. Treasury securities, are considered among the safest investments in the world. They offer predictable interest payments and return of principal at maturity. While the yields may be modest, the security they provide can be invaluable. Municipal bonds, issued by state and local governments, are another option. They often come with tax advantages, making them particularly attractive for retirees in higher tax brackets. Corporate bonds can offer higher yields than government bonds, but with slightly more risk. It's wise to stick with investment-grade corporations, those with strong credit ratings, rather than venturing into high-yield or junk bonds, which carry a greater risk of default. Bond funds and exchange-traded funds, ETFs, focused on high-quality bonds, can also provide diversification within the fixed income space. Certificates of deposit, or CDs, are another safe haven for retirees. These time deposits, offered by banks and credit unions, pay a fixed interest rate over a specified period. They're insured by the Federal Deposit Insurance Corporation, FDIC, up to certain limits, making them virtually risk-free. CDs are particularly useful for retirees who don't need immediate access to their money and want to lock in a guaranteed rate of return. Laddering CDs, staggering maturity dates, can help maintain liquidity while still earning competitive interest. Savings accounts and money market accounts, though offering lower returns, provide liquidity and safety. These accounts are also FDIC insured, making them a reliable place to park emergency funds or cash needed in the near term. While the interest rates may not keep pace with inflation, the primary goal here is preservation of principal and ease of access. For retirees willing to accept a modest level of risk in exchange for the potential for higher returns, dividend-paying stocks can be an attractive option. Blue-chip companies with a long history of stable earnings and regular dividend payments can offer both income and the potential for capital appreciation. Utilities, consumer staples, and healthcare companies often fall into this category. Dividends provide a steady stream of income, and reinvesting them can enhance long-term returns. However, it's important to remember that stocks carry market risk, so they should be only a portion of a well-diversified portfolio. Real estate can also play a role in a retiree's investment strategy. For those who don't want the hassle of managing property, real estate investment trusts, or REITs, offer a way to invest in commercial properties, apartment complexes, and other real estate ventures. REITs are required to pay out most of their income as dividends, making them a popular choice for income-seeking retirees. As with stocks, the value of REITs can fluctuate, but they often provide a hedge against inflation and can diversify a portfolio beyond traditional stocks and bonds. Annuities are another tool many retirees consider. These insurance contracts can provide a guaranteed stream of income for life or a set number of years. Fixed annuities offer predictable payments, while variable annuities allow for investment in sub-accounts that can fluctuate in value. While annuities can help manage longevity risk, the risk of outliving your savings, they come with fees, surrender charges, and sometimes complex terms. It's essential to fully understand the product and work with a reputable provider before committing. For some, maintaining a portion of assets in cash or cash equivalents is a prudent move. This provides flexibility to cover unexpected expenses or take advantage of opportunities as they arise. Having a cash buffer can also help retirees avoid selling investments at a loss during market downturns. While these investment options offer a range of safety and income potential, it's important to avoid common pitfalls. Chasing high yields often leads to taking on excessive risk, which can be disastrous for those with limited time to recover from losses. Similarly, falling for investment scams targeting retirees can erode hard-earned savings. Always conduct due diligence, seek advice from trusted financial professionals, and beware of offers that sound too good to be true. Tax considerations also play a significant role in retirement investing. Drawing income from tax-advantaged accounts such as IRAs or 401ks requires careful planning to minimize taxes and avoid penalties. Roth accounts, which allow for tax-free withdrawals in retirement, can be especially valuable. Working with a tax advisor can help retirees structure withdrawals and investments to maximize after-tax income. Ultimately, the best investment strategy after 60 is one that aligns with your unique needs, goals, and risk tolerance. Regularly reviewing your portfolio, adjusting allocations as circumstances change, and staying informed about market conditions are all part of maintaining a safe and effective investment plan. Retirement is a time to enjoy the fruits of your labor, pursue passions, and spend time with loved ones. By focusing on safety, income, and prudent diversification, retirees can build a financial foundation that supports their dreams and provides peace of mind for the years ahead.